All right, this house in Snohomish, Washington on 2.5 acres is listed at $735,000. And I'm going to be talking about what it would look like to buy this house if you have $100,000 in cash to put all into the deal. So I'm going to make this video because I know that when you're looking into buying a house, there's a lot of different concepts that are kind of abstract that you have to put together. And what I want to do is make a video in the greater Seattle market for people in this market specifically who can just watch this one video and make it less abstract, make it more concrete around this one house, and think through a real house, a real quote, and a real scenario that can help you learn these concepts and also start to get a sense of what the numbers might look like even if your scenario is a little bit different. So let's get into it. My name is Landon Buto and I'm a mortgage advisor based in Bothell, Washington with Cleveland Street Mortgage. We love helping new clients with loans, so if you'd like to see what it's like to work with us, check out the video linked in the description below. You can see what our process is like and if it would be a good fit for you. Let's look at this house. So real quick, let's look through just the specifics of this house, so it's not just a bunch of numbers, so you can see what we're looking at. So it is in Snohomish, Washington. You can see it's a single family residence. It's built in 1956, 2.5 acre lot, a little bit over 2.5 acres. Here's some pictures we can look through. You can see it's not, so for this price point on that amount of land in Snohomish, it's pretty impressive. I'm surprised at the listing. Maybe it'll end up going for a little bit more than that. You can see it's not super updated, but it is a nice, comfortable house. It's 3-bed, 2-bath, and yeah, you can definitely see it. It could use some updating, but it's not like it's one of those listings that says could use some updating and then just looks completely run down. And then obviously it's a fun area, fun property. Lots of opportunity there if you're interested in having a little bit of space and doing some work on the property. Awesome. So let's look at the assumptions that I'm making for this loan, because when you're getting a mortgage, it's not just this is your income level, this is your credit, and here's your interest rate. There are different factors that go into what your resulting monthly payment are. And so I'm going to look at a few of the key ones. These aren't all of them, but I'm going to look at a few of the key ones. Obviously, the purchase price is going to be $735,000. That's what I'm using. That's what I'm assuming. Taxes of $73.95. So you can go down when you look at the listing on Zillow. You can go down, scroll down to. I need to go back to the listing. You can scroll down to kind of the market value section, the public tax history, and they have their taxes on here. Those aren't always super updated, so you can click to the county website and they link directly to the tax statement here. So you can check that out here, and that's where I grabbed this number of $73.95. So that's what I'm using. So purchase price of $77.35,000, taxes of $73.95. And then I'm assuming homeowner's insurance of $2,100 annually, and that number could vary. It's not a set in stone number. It's dependent on your insurance provider and what you have covered. So that could vary widely. However, a pretty common number for this kind of price point that we would use is around $150. I'm being a little bit conservative and using $175 a month for this estimate, which results in $2,100 annually. So these two components here typically are included in your mortgage payment, and I will include them in the quote in your mortgage payment. You'll see that in just one second, but they don't necessarily have to be. There's more to that. Typically, you can just kind of assume and not worry about these as being separate. You can just kind of assume they'll be part of your monthly payment. If you're really curious about why you would, when you could have them separate, have them pay them on your own and not pay them to the mortgage lender, you can check out this video. I'll link here to my dad's YouTube channel, Mortgage Mastery Theater. Check that out. Credit score of 740 is what I'm assuming, which is a pretty good credit score. This is primarily going to impact your mortgage insurance. You'll see mortgage insurance as a part of the monthly payment on the quote. And your credit score is primarily going to impact your. Let me talk about mortgage insurance real quick. Mortgage insurance, sometimes you'll hear people tell you you need to avoid mortgage insurance at all costs. Now, there are sometimes good reasons to avoid mortgage insurance pretty purposefully, and if you can avoid it, if you can get to that 20% down and you have no other good reason for being below 20% down, if you can get to that 20% down mark, which is where mortgage insurance is no longer required, then great. However, I think that the avoid mortgage insurance at all costs idea is pretty silly. Because once you quantify it, once you realize how much mortgage insurance is and you compare it to your alternatives, then you can make your decision. Now, you still may decide, no, it's not worth it. I'm not going to take on that cost. But the at all costs idea is pretty silly. So mortgage insurance is something you have to pay if you're less than 20% down on a house. And it's in order to protect the lender from the chance that you default on your loan. So if you are more likely to default, which happens if you have a lower credit score or if you have a lower down payment, then your mortgage insurance might be a little bit higher. You'll see that reflected in the quote. If you have a high credit score, if you have a higher down payment, but still under 20%, then your mortgage insurance might be a little bit lower. So we're using 740 as credit, and that's pretty good. I'll just leave it there. Let's move on. First-time home buyer. I'm assuming that which for us is significantly impacting the pricing of the quote that I'm using. So you'll see the interest rate that we end up seeing, and then sometimes the mortgage insurance. Those are sometimes products of good access to good programs that have good pricing. And sometimes only first-time home buyers have access to that kind of thing. So that's why I'm including that here as an assumption. Debt to income ratio, I'll explain that a little bit more detail later, but basically debt to income ratio is your total monthly debt divided by your gross monthly income, and that generally has to be less than 50% in order to qualify for a loan. I'm not going to get into detail on that right now. But as a general rule, that's helpful to be aware of. Total monthly debts over gross monthly income. And that's income in the eyes of a lender. That's usable income. Sometimes you have income that, because of various lender stipulations, they want to know your income is reliable. So they have various rules to prove whether income is reliable. And so that income that's used for this calculation has to meet their standards. All right, so here is the quote. There's actually two different quotes that I've drawn up here. And remember, we're coming into this loan with $100,000 available for the purchase of the house, all in. That's down payment and any closing costs involved. And so we're going to bear that in mind. And so I've made two different quotes that use that $100,000, and you can see down here, neither of them is actually quite at $100,000. Just because it didn't make sense given the increments that we were able to hit to use that $100,000. So I just said, hey, pocket that, save that. We don't need to use that. That's given this hypothetical borrower scenario. Maybe it would make sense in your situation. But the main thing that you have to understand in order to understand the differences here is, okay, so let's look at the obvious difference. Is the total monthly payment is the first thing you see. One of them is $53.08, one of them is $48.10. And so you say, okay, why did that happen? Why do we end up with those different monthly payments? And one thing you can see here pretty quickly, probably the next thing you notice, is that one of them is a 90% loan to value. A larger loan amount here, $661, or sorry, a smaller loan amount, $661, and then over here it's a 95% loan to value. So this is 5% down, this is 10% down. We'll label that 10% down, 5% down. Okay, so that doesn't really explain the problem because we see this monthly payment is higher on the 10% down scenario than this one on the 5% down scenario. So that doesn't really explain the problem. What explains the difference here is this section here, points or credit. And so basically what I did is I used that $100,000 that we had coming in, I used it differently in these two scenarios. On the left, with the 10% down, I used basically all of it towards the down payment. But on the right, I used some of it towards points, and I will explain those in more detail later, but essentially points are a fee you can pay up front to the lender in order to get a lower interest rate. And so the reason I did that here is to illustrate different ways you can use the money that you have coming in. It doesn't necessarily have to be all towards the down payment. And basically the reason you would do that in this scenario, there could be a few different reasons. If just for some reason you don't want your monthly payment to be over $5,000. How could I get this house? I really want this house, but I don't want my monthly payment over $5,000. Well, we could use points to get this down here. So you can see there's a bigger impact, even though it's pretty much the same amount of cash. The cash over here has a bigger impact in lowering the monthly payment than the cash over here. The difference is all of this cash in the 10% down scenario is going into the house, which means you'll have access to it. Either you can tap into the equity, you can get it back when you sell it, whereas over here, these points, you're not going to get that money back. It's a fee you're paying to the lender. You're not going to get that money back when you sell the house. So generally, like I mentioned, you could have that kind of monthly payment comfort rule. That might be a reason. However, generally, probably the reason you're doing this is because, remember, debt to income ratio has to be 50% or less than 50% generally. So say here, the income it would take to qualify for this scenario over here, you come in and you say, I want this house. I'm really motivated on this house. It's a perfect place for me, but I can't qualify for the monthly payment even if I put 10% down. And even if we used all $100,000, we only used $88,000, but even if we used all $100,000, it wouldn't have gotten us significantly lower. Another $12,000 isn't even a dent on the loan amount. So it wouldn't have gotten us a significantly lower monthly payment. So you say, I can't qualify for this. It would take $10,616 a month in income to qualify for this. And I can't qualify for this, but I really want the house. So, mortgage advisor, lender could look at it and say, okay, let's take your cash, take the cash you're already using, put 5% down, but then use the rest of points and see what our resulting monthly payment is. Resulting monthly payment is much less. It's $500 a month less, which means $1,000 a month less in qualifying income. It's about $9,620 in qualifying income. And so maybe you can qualify for this monthly payment. Maybe you make that income. You don't make this income. You can qualify for this. And again, this isn't affordability advice. It's not financial advice on what you could afford. Sometimes just there's income that you can rely on, that you can count on, a second job, a spouse's income, bonus income, whatever. Income that you can rely on that won't qualify in the lender's eyes. So that's just a way you can use your money. It's just an illustration of how points can work. That's kind of why I made these two different quotes here. But it's not something to, we'll talk a little bit about the strategy in just one moment. Okay. So a few other components of the quote that I want to highlight, but I'm not going to spend too long here. But I just want to quantify some things for you. Remember, we're trying to get a concrete picture of what this could look like. So buying the interest rate down in the 5% scenario got you a 5.25% interest rate versus a 6.999% interest rate in the 10% down scenario. That's significantly higher, which is a big part of why your monthly payment is lower. So you look at the principal and interest. Even though the loan amount is larger in the 5% down scenario, because you're only putting 5% down, so you have a larger loan amount, even though the loan amount is larger, the principal and interest portion is a little bit lower in the 5% down scenario because the interest rate is so much lower. This P&I section here is a combination of the every month, what are you paying in principal and interest? And every month, that's going to be the same. But the portion of that is principal will change every month. The portion of that is principal and the portion of that is interest will change every month because every month you're paying interest on the remaining loan amount. And every month, the remaining loan amount gets a little bit smaller. So every month you're paying a little bit more. That portion of your monthly payment is a little bit more in principal than it was before, and a little bit less in interest, which is great. Okay, so the other component is mortgage insurance. In the 10% down scenario, you can see it's $116. In the 5% down scenario, you can see it's $163. And the reason for that is you're going to pay more in mortgage insurance when you put a smaller down payment because you're a little bit more of a risk. That number, again, that's a pretty decent number. I actually picked this loan product over a different loan product because it had the best mortgage insurance, whereas other similar products had more expensive mortgage insurance. So you could definitely see, especially on this kind of loan amount, a little bit more in mortgage insurance there. If you're smaller loan amounts, you could look a little bit under. But even on smaller loan amounts, this is pretty good pricing on mortgage insurance as of right now in our area. Taxes and insurance, so these are going to be the same in both 616 and 175, and we've already covered those a little bit. So you can see that results in 10% down, no points, in fact 939 in credit, which is not much, but it's basically the lender is crediting you that amount in order to take an interest rate slightly above the par rate, the going rate. So 10% down, basically no points. You end up with, and then other closing costs of $13,000, almost $14,000. You end up with about $88,000 in total cash all in for this house. Whereas in the 5% down scenario, when you're paying about $42,000 in points, you end up with $94,000 cash all in, and that is $14,000 of closing costs. And closing costs include a variety of things. They include, just everything that it takes for you to get that house transferred to your name. There's a lot of different parties involved. There's tons of different people working on the project to get you the house, to get you the loan, to get you the title, to get the records transferred to your name, and a lot of that is covered in closing costs. All right, real quick, I want to cover some key concepts and key things to consider. So debt to income ratio and qualifying. Basically, biggest thing here is just be aware of how that ratio is determined. That'll help you be able to understand what's going on with the lender, how they're deciding what you can qualify for coming into the loan, and be clear on what kind of income they're using. Get creative. Make sure you're purposeful about choosing a lender, because some mortgage advisors, some lenders, some loan officers do a much better job about getting a larger amount of income to qualify in the eyes of the lender than others, right? To qualify in the eyes of an underwriter who's checking the loan to see if the lender will take it on. Some mortgage advisors, some loan officers are a lot more creative, a lot more skilled at getting and just knowledgeable about making sure you can qualify for the max amount of house, max amount of loan you could. My dad, Chris, is our designated broker at our company. He has a CPA background, and he's just been doing this for years. And a lot of times he's really good about getting people to qualify for more income, creative ways to help people qualify for more income than other lenders would be able to. Just the other day, he was advising another loan officer from a different company that we didn't know. We didn't benefit from the loan. He just was providing some free advice on how to help someone, one of his clients, one of this other lender's clients, to qualify for more income, qualify for more house. And so, make sure you're choosing a good loan officer who's going to do a good job of that. But just be aware of that, and then separate in your mind qualifying and affordability. Come in with a strong idea of what you can afford. Think that through ahead of time. That may be obvious, but think that through ahead of time in terms of what you can afford, and separate that from what you can qualify for, and have a strong idea of what you can afford. And then, sometimes it's helpful to be flexible. Obviously, you don't want to go with whatever whim, whatever house pops up. Oh, sure, I can afford that, just because I really like it. Be mindful, but be a little flexible. I think sometimes helps. This isn't financial advice. I'm not a financial advisor, but I think that helps to just come in, because you're going to be in this house for a long time. So So if you say no to a great house just because of some rule you subjectively set for yourself about what your monthly budget, monthly payment on your house should be, one time, it's a long-term decision. So have a little bit of flexibility, but be wise about it, obviously. Use of points. What I'm going to say on this is get a mortgage advisor who you trust, who can explain this to you well, because they can be used really effectively and to great good. They can be a really valuable tool. Points, paying points. However, they could be a waste of money, and the differentiator is what your needs are and how lenders are pricing points at the time. Because the cost of points, sometimes lenders will make it cheaper to get a lower interest rate, and sometimes they make it more expensive depending on what they think the market's going to do and depending on how long they think it will be before you refinance and how long you will be benefiting from that loan. What I'll say in short is generally lenders price points in their favor so that they benefit, because if they know you're going to pay them $5,000 up front to get quarter point lower in interest rate, they know they're pretty purposeful about making sure that they're going to benefit from that, which means if they're benefiting from that deal over the long run, then you're, again, it's not just a dollars and cents thing, but if it's just about making money, if it's just an approach to, I can pay a fee up front to get a lower interest rate, and I'm going to be in this interest rate for 30 years, so over 30 years I'm going to make $10,000 back. No, it's not that straightforward, because you're probably not going to be in that loan for 30 years. So just be purposeful about that and get good advice from your mortgage advisor. Loan types, the concept to be aware of here is that there are lots of different loan types. So ask questions. Ask your lender questions. Don't just come to a bank. Don't just call a bank and say, hey, I need a loan. And they say, sure, get me this documentation and here's your loan, right? You want to be informed at least about a little bit about why they're choosing a particular loan for you, because home loans are kind of like tools in a shed. There's not just one. There might be one that could do the job for you, but that doesn't mean it's going to do the job best given your needs. So you want to make sure you're purposefully choosing, your mortgage advisor is helping you purposefully choose a loan that's best for your needs, because there's tons of different loan products out there. It's not just one loan. So the main four types are conventional, FHA, VA, and USDA for kind of these residential purchases. But within each of those, there's tons of different specific loans and products. Those are just the broad type. And so your lender could choose one versus another, even just within conventional. And they all have different impacts on you and your financial situation, and what you can do with that loan in the long run. And so just ask questions of your lender to make sure, and your loan officer to make sure, to see why they're doing certain things and make sure it fits your needs best. Rate locking, I'm going to skip this for now. Basically, when you get a quote, it's that the rate on the quote is not guaranteed. You have to pay a fee in order to lock your rate. I'm going to leave it there. And this is a big one, and you're probably already aware of this, but just be cautious with financial decisions as you're starting to think about buying a house. If you're thinking about buying a house, financial decisions you make, big financial decisions you make, could not only prevent you from getting a loan, even if they don't quite prevent you, they could also impact your pricing significantly. So even if you make a financial decision that doesn't prevent you from getting a loan, it could still mean that you get significantly worse pricing and a more expensive loan, a higher interest rate, higher mortgage insurance, whatever, because you made that financial decision. So as you're starting to look for a house purposefully, once you get within a year, 2 years, and just check in with your mortgage advisor. Get a good mortgage advisor you trust, and check in with your mortgage advisor every time a big financial decision comes up, and Sometimes it could not matter. Be like, yeah, okay, go ahead and do that. But things like credit changes, a new loan, things like just big purchases, could this $10,000 that I'm going to spend on X make a difference in 6 months when I'm going to be buying a house? I already have that $50,000 set aside. Could this $10,000 make a difference? Check in about those kind of things. Job changes. If you're thinking about a job change, even if it's not moving companies, even if it's within your company, changing roles, check in about that. Raises, as your boss mentions, hey, I might have a raise or a bonus coming up. Talk to your mortgage advisor about how that could impact your home buying prospects, and just get a mortgage advisor who truly is an advisor and who you can check in with those things about, and those things make a difference. So make sure you're checking in about those things, and be cautious and purposeful about those things. If you want to learn a little bit more about the process and what the process looks like of buying a house, specifically with our team, there is a link in the description here that you can click and watch a video of what it's like to work with us, what our process is like, and see if it would be a good fit for you. If it's a good fit, we'd love to work with you. We'd love to have you reach out. Even if you just have questions and you're not quite ready to work with us, there's links in the description for contact information, email, call, text. We love new clients. We're licensed in Washington and Idaho, and we'd love to be a resource, even if you're a year or 2 years out and you just want to start asking questions. Again, it helps make a plan ahead of time, so please do that. And check out any other videos with different scenarios in my channel as well.